Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, everybody. So let's take a look again at the gold market. Gold market right now stands in a very interesting environment where the long-term factors, driving factors, and shorter term are drastically different. So widely different. We have brought in these details as usual in our weekly report. Shortly speaking, in longer term, we think that the big mess is just yet to start. And from that standpoint of view, we think that the gold market and gold in general right now is still cheap because big events are still stands ahead. And we keep our long-term bullish view on the gold market as well as 28.70 as the next target. But in the shorter term, situation stands really specific is because gold market right now is driven by non-gold driving factors. They are mostly related to the liquidity problem in the United States, and in general we see some signs of weakness in the technical performance. Only some external big driving factors, geopolitical factors, could push gold to the higher levels. Performance on this week might be treated as an example what I mean. That gold market is a bit tired and the enthusiasm of the bulls now is gradually housing because everybody needs to take the breath. And on the background of the rising United States yields in the United States and demand for United States dollar, it brings additional headwinds for the gold performance. Actually, we briefly already talked about this yesterday in the video on euro currency. I could show you the same pictures in today's video. So, for instance, if you take a look at the 10-year bonds, just what rally has happened back to the 4% level. It's not surprising by the two reasons. First of all, the United States have printed the 20% of the total budget deficit just in 1 month. So, just the new financial year started in 1st of October. They have printed and issued additionally more than $300,000 billion in a debt. So this is outstanding amount. At this first moment. Second, you could take a look what's going on with the dollar index. It is also showing strong upward action, and this is where yesterday in details explained what really has happened and why this rally on the dollar stands. This is just some actually lack of the liquidity in United States money market. Additionally, this increases the inflationary expectations in the long term, and together both these factors are bearish for a gold market performance in the shorter term. So this explains why we prefer to be careful and gentle with the considering taking of any new long position from the gold market. And also there are technical reasons exist for that. So first of all, you should understand that here when the market stands in a flat action, you should not forget that actually we're at the monthly OP. And take a look at the monthly chart. We're at monthly OP. We're at monthly overbought area. We're in the quarterly overbought area. And October right now, take a look at the inside month. So market was not able to pass for this area despite all the payrolls, some escalation in the Middle East, all this rocket launching and so on. Yes, it was minor jump to the intraday target to the 27. As we said, market should fluctuate around it, but we're still at the monthly OP. And combination of the monthly major target with the overbought, first of all, technically it creates a directional bearish pattern, which calls as a kibbe trade, is some analog of the stretch pattern, but also it tells that this is obviously even without any stretch or anything, it's obviously not the best placement to consider taking of the new long position. Maybe it sounds a bit conservative, but and maybe you will not make a mistake if you still will buy here, because formally we have bullish context on the daily, but we prefer to follow the probabilities in the current circumstances, and probabilities tells that this is not best place for taking new long position, at least on the daily and above time frames. So our conclusion here as follows: if you trade on the daily and high time frames, we prefer to wait for a moderate pullback here on the gold market, because the problem is also around this liquidity shortfall in the United States. It's difficult to say what the degree of this problem is. So whether it's very short term and actually it's already eliminated, or it's some lasting problem and some structural problems exist. Unfortunately, from the public data, we can't estimate that. And this brings additional risk. And it means that in some unexpectedly, gold might appear to be under very strong pressure of the dollar demand when investors just need cash. Something that what has happened on the 5th of August, if you remember this, unwounding of the Japanese yen carry trades. This was just rally for the cash, nothing else. And on the gold market currently it might happen the same if investors start running for United States dollars. So taking it all together, our conclusion is better to wait with the long-term investment. So we prefer to hold existed long-term bullish positions, but for accumulation of the gold for long-term purposes, we think that it might be better moments very soon. Speaking about the shorter-term perspective, take a look what we have on the daily chart. Why I said that you will not mistake if you're trying to buy, because if some escalation will happen, you even could get the jackpot here. This market could jump occasionally, but well, based on this performance that we have, grabber is still valid formally, and market on the daily chart holds the bullish context, despite that we have the bearish trend. We have directional pattern that's still valid, but I do not like the performance on intraday charts. So on the full time frame chart, despite all these payrolls and anything, triangle has not been broken. On the hourly chart, returning back to idea of our some kind of the hand and shoulders of what we have discussed, market for a few times, 3 times, was not able to break the neckline, which is just make it evident some tiredness in the gold market. And any pullback here that has happened, all the pullbacks have created the new lows. So the pressure of the bears increasing in the short term. All this stuff together makes me just stay aside for a while from the long-term position. If you trade on intraday charts, I would watching for some clear bearish setups, clear bearish patterns. When this choppiness will come down a bit, we will see what will happen, because very often failure hand and shoulders leads to appearing of the butterfly patterns to the downside. It means that gold theoretically might try to touch levels such as 26 and somewhere at 26.15, which will be might be the 127 extension. So that might be significant downside continuation once the problem and these lows will be taken out. So just wait for clear patterns that may be formed on intraday charts. That's our current opinion. And 2 words as a bottom line: we are waiting for better entry levels for longer term bullish positions. In the shorter term, those who trade on intraday charts, we suggest that it would be better to watch for clear bearish patterns before taking positions. So we're considering bearish positions on the intraday charts. So that's our 2 cents on the gold market right now. Let's see how it will turn next week.